it's just a difficult situation for working when you're working with customers, either sellers or buyers. You have to take a look at what's going on in the insurance market today. So what we're going to cover is homeowners insurance to start with, and then we're going to talk about the FEMA flood insurance that's kicking in April and still, but it's really in effect now, and some of the things that we think are good for you to do working with your customers. So just to start out, the normal contract, whether it be FAR/BAR or NABOR, does not allow for someone to get into a contract, find out the insurance is going to be sky high, and then just walk away. Obviously, if you're in an as-is contract, one of the first things you want to do is your insurance due diligence to make sure that you know what you're getting yourself into. So it's really important. We're going to talk a little bit about the homeowners insurance market first, then we're going to talk about flood. Rich, give us some insight into what's going on in the market. It's pretty difficult out there, isn't it?
Yeah, it's getting bad. I was recently on a conference call with one of our carriers, and they explained to us that we're over the cliff now with the insurance rates. We're in a free fall. They anticipate probably between 1 and 3 carriers to go insolvent this year, which basically means they're going to go bankrupt and they're going to stop honoring their policies. So the state's going to have to buy them back. And that just makes it that much harder, because there's already so many companies out there that are limiting their underwriting guidelines to roof years. Right now it's tough to find whether it be a tile or a shingle roof older than 12, 13 years. It's almost getting hard to place that. Some companies don't want to write anything that's older than 02. Some are older than 95. Some are older than 2012 now. Some will only go, the past 10 years of construction. So it's getting difficult out there. And there's, in our agency, we feel comfortable. We have about 13 different homeowner carriers we write with. All we have vetted and spoken with their marketing reps and their ownership teams and verified that they are all in good financial areas. Kathy, yes, Federated National FedNat is one of the ones we write with. They were in the news recently, just to catch everyone up on them. So FedNat owns FedNat, Monarch National. They write homeowners Monarch National. Then they purchased a company called Mason Insurance. Now, Mason came in right after Hurricane Irma. They were a New Orleans-based company. They came in and they bought a lot of policies from Citizens for wind only. FedNat bought them with the hopes of launching a mobile home only policy for mobile homes because there's not much option out there. Long story short, FedNat purchased them after doing some research with their guidelines and their company. They are dissolving Mason. So Mason got downgraded. So FedNat is not even bringing them onto their books. They're kind of walking away from the deal. They're closing down Mason, and FedNat and Monarch National are the 2 carriers that they're writing with, that they're confident with. I actually was on the phone last Tuesday with their management ownership team, and they said that they could easily withstand another 7 to 8 Irma and Michaels before they would even have to dip into their reserve funds. They are a publicly traded company, so they are a little bit more scrutinized than others when it comes to their financial stability, but they are financially sound. They have been reassured. Demotech has redone their rating, and FedNat and Monarch are in good standing. That's a big company to watch for because they write coastal. So anything that is in that wind pool, Marco west of 41, FedNat is very viable and good options usually for homes that are in those territories.
All right. So I have a few points that I want to bring up about homeowners insurance. Stephanie's in. Let's see here. How do we switch to the next slide? Okay. Technical difficulties are ensuing here. I'm trying to switch to the next slide and I can't figure out how to do it. Page down doesn't work. Arrow down doesn't work.
Maybe try resume slideshow up there in the corner.
Yeah, okay. Can't get the mouse to work here too well. Resume slideshow.
It's over there in like the upper left corner, right below draw and design.
Oh, okay, yeah, I see it now. If I can get the mouse to go over there. Like right there.
Yeah, just down a little bit. It's popping up on my screen right below where, oh, it just went away. I think it's that button there though.
There it is right there.
Yep.
All right. So the first section is we'll just run through homeowners insurance, some bullet points for you to consider. Rates are rising very quickly. Citizens, which is the insurer of last resort, Florida. We could talk about thanks to Charlie Chris, but we won't go there. Their rate cap is 10%. They are on a glide path through some new legislation of 1% per year up to 15%, but they can only raise their rates 10% per year. Correct, Rich?
That is correct, yes. And they have a maximum coverage of 700,000.
Okay, so the coverage isn't as good. It was designed to be the insurer of last resort for properties that nobody would write. And it came in during the hurricane, when we had all the hurricanes, with the idea that we were going to save everybody money. In the process, we drove out all the major carriers in Florida. So rates are on the rise. Citizens insurance cap is at 10%. And Citizens has now doubled the number of policies they have from 400,000 to over 800,000. And that's expected to go way over 1 million this year. These are people that have no other option. There's not a carrier that'll write them with a reasonable fee. So we're seeing Citizens repopulate. We just had them on the Florida Realtors Insurance meeting last week. And they're basically saying, hey, we're doing the best we can. But they're still financially pretty solvent to be able to pay a claim for a major storm, but the coverage is not as good. So it used to be, what was it, Rich? If you had a carrier that was within 15 or 20% of Citizens, you had to stay with that carrier.
Correct,
Now,
right. Mm-hmm.
Their rates have gone up way over this 10% limit. And, the other carriers are now, with less coverage, the other carriers are now way over 20%. What kind of rate increases are you seeing out there?
Right now, this year, we've been seeing an average of like 25 to 40%. I've seen some in excess of 60. I even worked on one yesterday. It was an 80% increase on a condo, which astronomically, it was crazy. We were able to get them rewritten with another carrier and save them a little bit of premium, but it was crazy.
So the point is if you're working with a buyer, especially if the buyer's looking to get a mortgage, this is a bridge you need to cross early on to make sure that there is going to be insurance and what the cost is going to be, because it can be astronomical. Can you assume an existing homeowner's policy if you're buying a property?
No, you cannot. Well, the majority of the existing homeowners policies in Florida, no. If it's a high value policy with like a Chubb or something like that, that could be possible. But those are special cases, high value, and we're talking coverage in the upwards of 3, 4, 5 million. That sometimes can happen, but generally speaking, on an average homeowner's policy in Florida, no, there is no assumption of policy or taking over of policies. No.
Okay. So the next topic that I kind of wanted to bring up is roof replacement. Obviously, a lot of people got their roofs replaced as a result of Irma, And as a result, a lot of people are getting non-renewed, right? So if you have a customer, oh, I just got a new roof from Irma, chances are you can maybe get new coverage because it's a new roof. But because of all the roof replacements, I think is that the single biggest impact they've had on other insurers. Rich?
Yes, and it's a trickle down effect. So obviously Irma, damaged a lot of roofs, a lot of homes. But I would honestly say there's probably as many number of people that filed claims for Irma that never had payouts because for whatever reason, I know it happened in our office a lot. People were up north, didn't know the damage, couldn't get anyone over to the house. So they just called their insurance company to have them go look. Okay. Most of the time, if there was damage, it got handled, claim filed, all good. But a lot of cases, we're running into this a lot now, where claims were filed and there was no payout. The claims are closed, so that tells us either number one, there was no damage, or number two, the damage was under the deductible, so there was no payout. What the issue with that is, there are insurance companies now that when they pull the comprehensive loss history report, they see that a claim was filed due to Irma, so they require a 4-point inspection done now to make sure if there's no existing damage. The hurdle is with a lot of people trying to close quickly, they're not necessarily getting mortgages. So they're basically accepting the home as is with no inspections. And so that sometimes hinders or knocks out certain carriers, because if we cannot provide them the 4-point inspection before binding, they won't allow us to bind it. Usually there's other carriers that we can find, but sometimes they're more premium. So trying to get an inspection, again, I'm not an agent. I'm not a real estate agent. So I get that sometimes that's a hurdle as well. But from the insurance standpoint, if a claim was filed, we're probably going to have to see either a pre-purchase inspection or a 4-point. I don't like sending in the pre-purchase inspections to the insurance companies because it gives them way more ammo to look at something and say they don't want to write it. Where the 4-point only looks at the HVAC, the roof, the electrical, and the plumbing, which is generally a little bit more. It's a little bit easier generally than the full pre-purchase inspection to look positive.
Okay, so the first question now is if your roof of the home that your customer's buying or the seller has is over 10 years, a lot of policies are non-renewed, right? I mean,
Okay,
they're
so
really cutting
yeah,
down
so
on the.
shingle roof, absolutely. No more than 10, 11 years of a shingle roof and it needs to get replaced per the insurance guidelines. Tile roof, depending on the company, you can see anywhere from 15 to 25 years. Metal roof, you usually get about 25 years. But again, every company's guidelines are slightly different. And there's some things in the works. Some companies have started working some things called a scheduled roof replacement, where they'll put on the policy a scheduled roof replacement. So if the roof is 20 years old, they'll cover it, but maybe only for 25% of the replacement cost.
Yeah, that was
So
one of the items I had on here, but a lot of we're seeing some non-renewals because of roof age, correct?
that is
In other words,
correct.
you've been
Yes.
going along paying your premium, all of a sudden, sorry, your roof's too old. We're non-renewing it.
And,
A lot
and
of
they
non-renewal.
right, they disguise it as what they consider reducing hurricane exposure, or underwriting guidelines. So if they've changed their guidelines to say that a shingle roof can only last 10 years, if your shingle roof's 11 years, technically you don't meet their guidelines. So the state allows them to non-renew you. Now, they have to send the non-renewal 120 days before your policy end date. So you have a period of time to get that, rewritten. You probably can't get a re-roof done in that time, but the issue we fall into is so many of our homeowners in Florida live up north. If the mailing address is not the place where they are currently, it's not going to get forwarded because insurance documents don't get forwarded. And if the agent's not on top of it, because the agent gets notified, if the agent doesn't pass that notification on to the insured via email, it can be a little headache for some people.
Phil, do you have a question?
Yeah, it's Rich. Hi, Rich. Marge and I had a home that closed in Cape Coral. The roof was about 13 years old, I think 16 years old. But we were able to find insurance. So it seems like there's something different between what some insurers are saying versus the reality of the buyer going out there, searching the market, and they're able to find insurance needs. Sometimes they have to replace it in a year, sometimes it's a little bit higher cost, sometimes there's no inspection necessary at all. But we closed on that within a week, and everybody I talked to, every buyer that put an offer in was able to get insurance.
Did you hear the question okay, Rich?
Yeah, yes, I did, absolutely. And you are 1,000% correct. It's very rare that there would be a home that is completely uninsurable. Okay. Now, like I said earlier, we write with 13 carriers. There's some agents out there that write with 90 different carriers. Right, wrong, and different. Right, wrong, and different. We don't want to write with 90 different carriers because trying to keep 90 different guidelines straight is hard.
Yes.
There's homes in our office. I mean, there's sometimes I have no problem placing homes, and there's other times I have a hard time. And I never say to the insured or the agent, this home's not insurable. I say, I don't have an option for this home. I'm sure there's other agents that do, and I usually have a phone number of one or two that they can call. So very few homes in Florida, especially in Collier and Lee, are uninsurable. There are a handful though, but that home in particular, FedNat could have taken it. Possibly depending exactly on the year of the roof. Florida Penn Edison could have taken it. Universal Property and Casualty could have taken it. So there are a handful that we have. Edison and Florida Peninsula, for instance, they don't really have a hiccup with age of roof. They will not write anything that doesn't have prior insurance. So if it's if someone bought it and then a week later tried to insure it, that lapse of insurance would knock them out. But if it's a new purchase, that would be fine, even if the current buyer doesn't have insurance. But Florida Peninsula and Edison have some other things, like they don't include wind-driven rain and certain things like that. So there's companies out there, but sometimes you're sacrificing a coverage or your premium is higher based on it. So you are 1,000% correct. It just gets trickier for a shingle roof when you get in that 11, 12, 13, 14, 15 year age. If you get over 20 years, a standard homeowner's policy is probably going to be not right for a shingle roof. Now you can,
Rich, I appreciate that. I think that's my main comment, and for the people online and in the room, it's often the message back is this house is uninsurable. They're going to try and undercut it, and that's just not the truth. And so that's why I think that it's important to be clear that to anybody listening and to people in the room, you can get insurance on almost any home. I can insure my pitching arm if I want to insure my pitching arm and pay enough money.
Right, but I'm going to stop you real quick and just throw one little thing in there. You're 100% correct. However, I can write you insurance. Anyone can write insurance. I could write a DP1, a DP3. There's many different policies I could write. But the question is, when a claim happens, is the coverage going to be there? And that's the biggest thing as a trusted advisor that we try to be. That we try to make sure that's there. And again, there's a million different companies in Florida that write homeowners. We write with 13 of them. I today was on the phone with someone. They got a proposal from another agent. I'll be honest, it was a frontline option, blew mine away, was a much better rate. I told him, listen, that's a great policy. That's a great company. If it were me, I would take that policy. I don't care about selling a policy. Don't get me wrong. Everyone wants to sell policies. My whole thing and our whole agency's mindset is we want to make sure that the customer, walks away a little bit more educated. So in that case, if you would have brought that home to us and we didn't have a market, I would have said to him, listen, I don't have a market for this home due to the age of the roof. There are carriers out there that will cover it. I don't write with any of them. So maybe look for another agent. Here's two I can think of that have a lot of options that maybe would find something for you. And the
So-
last thing is there's this new company out there. Oh, and I just drew a blank on it. They're an online company. It's kind of like Geico, but for homeowners. They will write almost anything. It's called Kin. They'll write almost anything, but the coverage is suspect at best. But in a pinch, to get a deal closed, that might not be a bad option. Just understand that when it comes time for a claim, there's a lot of exclusions on that policy.
Okay, thanks, Bill. Thanks, Rich. So let's talk a little bit about inspections. I know the other day when we were online with the Zoom with citizens, they said they're going to begin inspecting to the rate where they hope to be in a few years, to be inspecting 60% of their policies. So right now, I don't think citizens inspects very much at all. And more companies are doing inspections, right, Rich? And that means that you could have been covered for a number of years, and all of a sudden now an inspection's done and now your coverage changes.
Right. So with the inspections, citizens specifically, they will require a wind mitigation and a 4-point inspection to be uploaded before binding. So that's why they traditionally don't have to do their own inspections, because a wind mit's good for 5 years and a 4-point inspection is only good for 1 calendar year. So as long as that they've been uploaded and they meet their guidelines, that's their inspection. Basically, they make the insured pay for it. Other companies will come out and do exterior inspections on most homes. Anything high value that's above 750, we're seeing a lot of carriers want to come and do a full interior and exterior inspection. And again, that all gets set up with the homeowner. They call them and they get it set up, and they come in and do it when it's convenient. If for some odd reason, and I've had a few of these, that the inspection couldn't get scheduled or couldn't get done, they don't cancel the policy. They just set it up for non-renewal. And they basically say, if you don't let us inspect the home upon your renewal, we're going to not offer you a renewal. So basically they have 7, 8, 9 months to get that inspection done. And then they'll lift that non-renewal. But yeah. And again, the increase in inspections is purely due to the hurricanes that we had a few years back, and then all the bad actors that have been filing false claims. Again, we haven't seen much of it in Collier and Lee County, but statewide, it's been pretty bad.
Anybody with questions, please put them in the chat. I'm going to monitor the chat there. Rich, we had something come up during our Florida Realtors meeting about coverage that's been bound prior to closing, and then after closing, the carrier comes out and inspects and cancels. And it was significant enough in the discussion that I'd like to ask you a little bit about it. Apparently, these are people that bound the coverage, moved in, closed, and then got a notice of cancellation. So is that something that can happen, or is it for those people just exceptions to the rule?
Well, it can happen. Obviously, it can happen for a couple different reasons. One, if no payment was made, because there's some carriers that will allow you to bind coverage without payment. So if the payment's not received, they can cancel it for non-payment. But exactly what you were talking about, the inspection. So if a policy gets bound, as an agent, we walk through the application with the insured, answer all the questions, and then they come out and do their inspection. And the biggest thing right now is let's say they find some of these solar panels that are what they are considered tier 2 regenerative panels. So basically they're generating between 10 kilowatts and 100 kilowatts of electricity back to the electrical company. That's called net metering, and the majority of homeowners carriers in Florida will not allow that. So there are some cases where an inspection has happened and something does not meet their guidelines, whether it be solar panels for net metering, water heater age, possibly, maybe there's roof tile damage or existing damage at the structure. Possibly there's an ineligible dog breed. Maybe they see that there's a pit bull and on the application, there was no mention of a dog. they can cancel the policy for underwriting reasons, for failure to comply to underwriting requests, or basically for lying on the application. Now they can't cancel it effective immediately unless it's for non-payment, because they send out generally 2 reminders for non-payment. But if it's something that doesn't meet their guidelines, they generally will cancel it effective 30 days. And they'll say you have 30 days, 30-day notice. We're canceling this policy due to underwriting review and guidelines. And then you have 30 days to find other coverage, which presents a whole nother hurdle, because now you've been canceled and every carrier is going to want to know why you were canceled. So
when a carrier cancels a policy, it becomes common knowledge to the other carriers before they write it.
Because a lot of the carriers, and again, not all, but a lot of the carriers have a question on the application. If you had coverage declined, canceled, non-renewed during the last 3 years? So that question's on the application. So if it's on that application, you can't answer it no if the answer is yes. Otherwise, that's a whole nother ball game of getting canceled. Again, there's carriers, you answer yes to it, they just want an explanation of what happened. And again, depending on what the guideline is, or why you got canceled, if it's an underwriting, guidelines, home doesn't meet underwriting guidelines, generally you can place out with another carrier, no problem. If it's because there's an existing damage, no one's going to take that probably. And then there's other carriers that some don't ask that question, and some that ask that question, if the answer is yes at all, they won't even offer an option. So it's not, there's a lot of moving parts there, but to answer, the simplest answer to your question is yes, they can cancel it after an inspection, after it's been bound, but they do have to give you notice.
Time to replace. Okay, cool.
Correct.
The last thing that I wanted to talk about was just to update you a little bit on the legislation. Last July, Senate Bill 76 went into effect, and it was to put a huge damper on one-way attorney fees. So for a long time, just to put it all in perspective, Florida has 8% of all insurance claims filed in the nation. They have 77% of all the lawsuits filed against insurance. So we have a lot of hotbeds where attorneys are using a corner or an option in a statute to file lawsuits. And so one of the biggest things we had was assignment of benefits, where you have a flood in your house, someone comes in and says, here, I'm here to take care of you, sign this document, you're assigning your benefits over to the plumbing company or whatever company is helping with your catastrophe. Meanwhile, they connect with an attorney, sue the insurance company, and the one-way insurance rule is, if I collect more than $1 more than the claim was offered, the payment was offered to me, I also have to pay your attorney fees. So sometimes you could have an $8,000 water claim and a $100,000 legal bill. And this went on for, I worked on this as, when I was involved with NABOR a lot more, we worked on it every year with Florida Realtors. It took us 5 years to get the first dent in one-way attorney fees, because most of the senators were attorneys, trial attorneys. So after a while, I think it just got so out of hand and the insurance rates kept skyrocketing up as a result, that finally the legislature did something about it, then tightened it up again last year with Senate Bill 76. So time will tell, but hopefully it's now harder for an attorney to tack on a big, they have to justify attorney fees when there's a claim settled. So any comment on that, Rich?
No, the attorney fee multiplier is the number one reason rates are on the increase. There were attorney fees that insurance companies had to pay out this past year in excess of 1.2 million, and not just one claim. There were about 3 or 4 different lawsuits that had payouts of over 1.2 million for just legal fees. The claim was a $40,000 claim payout, because they can triple their legal fees when they win a lawsuit like that. So it's crazy. It's definitely something that there is light at the end of the tunnel. I know the legislation is very active and they are working hard to make sure to get things fixed. And hopefully within the next year or so, it'll be all straightened out.
All right, so hopefully with any kind of luck here. Stop share. Okay, share screen. Yay! I ran through this with a lady that I've been working on the insurance committees at Florida Realtors and National Association for a number of years, is now vice chair of the NAR Insurance Committee. She put this together about risk rating 2.0 or FEMA 2.0. And we don't have to spend a lot of time on the slides, but I want you to understand that this has been an effort. We started working on this in 2016 to try to do something with the FEMA flood insurance program, which was pretty much out of control based on a lot of old mapping data and what they call pre-firm or pre-mapping data, where there was just a lot of rates that didn't have any relationship to the risk at all. So by employing a number of techniques, laser mapping and better risk rating systems, they partnered with Milliman to do an actuarial program where we're trying to rate the structure based on the risk. The result is generated a lot of rumors about everybody's flood insurance premium going through the roof. And what I wanted to do is to show you a little bit about how the system works and explain to you that Florida has been a donor state for years. We have 40% of the flood policies in the country, and we pay in $4 for every dollar that gets paid back to us. So we've been overpaying in Florida. That doesn't mean that somebody who was living in an older structure right on the water that had a grandfather rate wasn't paying their fair share, because they weren't. But overall, what we're finding with this new program is more people's rate is going to stay the same or go down a little bit, and it will increase. This slide deck now says the average increase will be around 9%. So obviously everything's got to go up a little bit to get to what we call actuarial. And this is a glide path to do that. So we'll go over a number of things, but one of the key things to remember is the cap is $12,000. You cannot pay, no matter what your situation is, you will not pay more than $12,000 a year. So they tried to set a cap, create an 18% per year glide path if your rate is going up substantially. And the attempt was to try to do something good. Rich will tell us if it's working in the field, but I just wanted to go through a few things. Any comments so far, Rich?
No, you've hit them all on the head so far.
All right, let's see if I can get this to work. There we go. So Cindy Hayden is my friend. She's vice chair of the NAR Insurance Committee. And this is a presentation that we worked on. She's updated a little bit just to tell you a little bit about how FEMA is working and what's going on with risk rating 2.0 and how you as a realtor can find out more information. How did I do that? There we go. So the NFIP, the National Flood Insurance Program, correct me if I'm wrong, came into account, Rich, when nobody would write flood insurance, correct? I mean, the carriers were.
That's correct, yeah.
We don't want to touch this. So the obviously now that the government said, let us handle it, everything will be fine. And lo and behold, it wasn't. But since the 70s, we collected 60 billion and paid out 96 billion. The program is really in huge debt, and the Congress continues to fund that debt. But if you take a look at some of the points here, NFIP payouts were 16.3 billion for Katrina, Harvey 9 billion, Superstorm Sandy went up through the Northeast, 8.8 billion, Hurricane Irma 1.1 billion, and Hurricane Ida cost unknown. So obviously there's huge payouts here. And in 2012, there was a thing called the Bigger Waters Act. It was two senators that passed this program. And their thought was, look, we've been paying out all these years. We got to stop this. We've got to make this program, pay for itself. And this is an example of a premium that came into effect for a $300,000 elevated home in January of '86. The premium was $87,574 with their rating system. So obviously, I think we worked on this actually with NAR and with Florida Realtors. We got, I think it was a year or two later, we got what was called the Quiet Waters Act, which backed off an awful lot of this stuff and put it back to more reasonable levels. But I mean, it got really ridiculous. So really, the whole flood insurance thing became not an option, right? And all these huge storms were coming in, and all these properties were rated so much differently. So here's a little timeline. We talked about the Bigger Waters Act in 2012, and what we called the Quiet Waters Act, or the rescission of a lot of the things in bigger waters that made it a little bit more workable. But back in 2015, I think I sat on the original NAR insurance committee, which said, hey, we got to do something here. This is affecting millions and millions of homeowners. And so it was about a 5-year process. They did bring a guy in that had a FEMA that was a business person, and really is a pretty good guy, pretty easy to work with. So this was all supposed to be done, I think, in 2019. It got pushed back a little bit. And now in April, we're going to start to see the effects of all of this work. So the rate tables that we have now were developed many of 50 years ago. There was quite a bit of, not too sophisticated mapping that came in the 70s. And really this is, how hard was it to do a quote, Rich?
It used to be pretty hard, especially a home that was in the flood zone, AE, AH, VE, any home in the flood zone, we needed an elevation certificate before we could even get a rate. And a lot of times, if the seller didn't have an elevation certificate or it was new construction, we had to wait till either the mortgage company ordered one or the buyer went out and had one done, and elevation certificates, it would always just delay it, where sometimes we'd be coming down to like a day or two before closing when we finally got it, and having to rush through and get the rates and things like that. I mean, good news is you didn't have to shop it around because NFIP is the same no matter what carrier you go with. But waiting on the elevation certificates and then getting photos and getting all that, it was a pain. And the problem is sometimes a home would just have a thick slab and not really be a true elevated home. And the elevation certificate may say it's an elevated home, which then would change the rate. So there were many issues with elevation certificates.
I guess you could call a couple different people, because the complexity of the rating, you get different rates from different people. So
yeah, depending how
the
the elevation survey, the certificate was filled out. Yes, absolutely.
So the other problem that happened, and this is an example here of two neighbors right across the street from each other, and they were near a creek, but the risk 2 on the right here of this slide paid $400, and risk 1 across the street, pretty much identical circumstances, paid $6,042. So the current NFIP premiums were shown there, 6,000 for one home, 400 for the other.
Jeff, I'm not seeing any slides that you're pulling up on the Zoom.
Pardon?
I'm not seeing any of the slides that you're pulling
You're
up.
not? Okay. All right. Wonder what it's showing in the room here. So Are you seeing that?
No, the only thing I see, and maybe I'm the only one, it just says get the facts about risk rating 2.0. It's the first slide of the screen.
Slide, okay. Mouse doesn't work very well either. Are you seeing anything now?
You're
No?
still seeing just the first page, yeah.
Okay. Hmm. Let's see. Sorry, guys. Not sure why this isn't working. All right, let's take a break. I'm gonna grab Jordis because I'm not sure exactly why
Well,
this is.
now it changed.
It did?
Now
What do you
it-
see?
well, it went to the second page that had Cindy Hayden's name on it, but now it's back to the first page.
All right. How about now? Seeing the
No.
agenda?
Nope.
No?
Now I see the agenda.
Okay. I can maybe do it this way. How, can you see the NFIP flood insurance program costs?
No, it's still on the agenda. Now it's the NFIP. Yep.
Okay. Well, it's interesting. I can't get that synchronized with what's going on in here.
I gotta do.
Let me grab Jordis real quick. I'll be right back.
Which one are you trying to share? Hey, Rich, can you see the PowerPoint now? Problem 3?
Yep. Now I see problem 3 now. Yes.
All right, wait a minute, before you leave, let me try to change it to, can you see neighbors with very different rates?
No,
Yes?
it's still says problem 3.
Let's just show it one thing at a time.
What about now, Rich? What do you see?
It still says problem 3.
Yeah, it's weird.
Now it says problem 4.
Let me know when it goes back to 3.
We can see it on our end.
Yeah, she can see it. There's just a delay then. You can see problem 3 now, Rich, again?
Yes, now I can.
Yeah.
Okay, all right, so it's just a delay?
Yeah.
Okay, all right, so sorry about all that.
Oh, you're
Um,
good. You're good.
The other more serious problem with FEMA is a fact that I learned was that 25% of all claims paid out by the NFIP were in X zones. So really, when you're working with your customer, coverage in an X zone or a low rate risk zone is really not only a few $100s per year. And all those people out in Houston that were in an X zone that didn't have coverage, they got a check from the government. The government will not bail you out, by the way. They got a check from the government for $4,000 or $5,000. The ones that had policies got 250,000 plus contents. So there's a huge difference. And when somebody says, well, it's 500 a year or 600 a year, I don't really need it. Guess again, I think there's a lot of merit to the fact that they're trying, by getting the rates more accurate, to offer some very good coverage at some very low rates. And the final problem was the number of repetitive loss properties where I guess it's more apparent with the fires in California where they burn the house down, build another house, burn the house down again. Same thing in flood. These properties sitting in a low zone continue to flood in episode after episode, and the NFIP was paying the claim out each time, which was really skyrocketing the overall cost to the program. So basically, under the new program, we'll see it in a minute, you get 2. You get flooded out, they rebuild it, that's it. So I think that was another one that was really a bad part of the old system. Can you see problem 4? Yes.
I see it small, not big. No.
Okay.
We're seeing it.
You
I see it now.
okay?
I see it now.
Okay, I think there's a delay in there somehow.
Yeah, that's fine. You can go ahead and go.
All right, so what happened with all of this was the pre-firm properties or pre-mapping properties and then became grandfathered in so that they were paying artificially low rates, right? And then those that had just come into the program were paying much more for the same coverage. And in high-risk zones, AE zones, things like that, the cost was not evenly distributed. So some people were paying very little, some people were paying quite a bit. The idea here is with a true risk management system, based on we know the elevation of your property because the entire state of Florida has been laser mapped. We know a lot of things. We know what the risk is. We know what the 100-year flood results are, and hopefully come up with something that's better than what we had. Okay, hopefully, Rich, you'll see problem 5 come up here in a minute. But under the old system, as Rich pointed out, you had to get an elevation certificate. If you had one with your survey, it was fine. If not, you had to have somebody come out, do the elevation certificate. And in many cases, that was the only way you could get an accurate rate. Because the rate that you were paying, if it didn't have anything to do with the elevation, you could then put in what was called a LOMA with your elevation certificate and a letter of map amendment. And you could get probably a little bit better rate. But under the new system, because everything's been mapped, and because there's a model for every individual unit, not just a street or an area of a street, the rates should be much more accurate. So as we talked all along, there was a lot of people that got involved in this risk rating 2.0, a lot of data, a group called Milliman, which is into the business of risk rating and risk management, mapping data, and a commitment. I know Florida committed several $1 million every year for a few years to map the entire state with laser mapping technology. So now each zone prices each home individually based on the data we have on each home and based on the risk that's being assumed. So now instead of a couple of variables, we now have a lot more variables, and we have a risk rating model and a lot of things that went into this that now don't require an elevation certificate because we have individual data on your house, and they're taking a look at all of this data that you can see on the screen here. But I mean, it's measuring the distance to the nearest flood area, river, or whatever. It's measuring your base flood elevation. It's measuring your foundation type. It's measuring things that can affect your risk. Okay, so if anybody wants these slides or a version of these slides, a few of them, I'm happy to send them to you. Okay, so here's a few examples. I think Rich brought a few to the last time we did this to show you that under the current rating, the maximum that you could pay under NFIP was $45,925. Now it's $12,000. So even though we're going to increase the cost of some of these homes, it's going to be capped at $12,000. So that, I mean, that's not an insignificant amount of money, but it certainly isn't $45,000. So just a little summarization here. The old NFIP, 50 years old, rates never stop rising. 2/3 of older pre-mapping homes were overpaying under the current system. And today, NFP rates can rise 18 to 25% per year till they hit 63,000. All of that stops when we go to risk rating 2.0, okay? So the new max is 12,125. 23% of the people will see a decrease using property specific factors. A lot of people, like 80% of the people we looked at in Florida, are going to have the same rate they're paying now, maybe down a little bit, but no major increase. But unfortunately, I would say that there are a number of politicians that have politicized this. They take a home that was underpaying, and now we're trying to get to actuarial, and they're talking about the impact on a few examples, and it's becoming a little bit of a political football. The fact is that Rich can give you a quote right away, right? I mean, it's a fairly simple thing to do. He can give you a quote, doesn't need an elevation certificate. You can get the information right away. And correct me if I'm wrong, the best thing you can really do, especially if there's a fairly high number there, is talk to the existing homeowner about assuming their policy, correct?
Correct. If they have an existing NFIP policy, that you need the policy, basically you need the copy of the declaration page, and that will get you a glide path rate, which is a much significantly lower rate than the 2.0 rate traditionally.
So one of the things, we're always looking for the prior title policy. We're always looking for a survey. Why not ask for the deck page for their insurance? And if it becomes a comparison that Rich can make, you can say, hey, look, if you assume this policy, you can save a lot of money, or it may not make any difference. But if we always get the title insurance policy, we always get the survey. Why not get the deck page from their flood insurance policy? Just it's easy to do, and then the buyer has the option. Can you see these slides now, Rich?
Yes, I can. And I have yet to see that a glide path rate be
Better?
everyone I've seen, the glide path rate has been better by a couple $1,000s. It's hasn't even been close to going to the regular 2.0 or, use the glide path is the best option available.
Okay. So remember, I mean, pretty much everything's capped at an 18% increase. So it's going to be 6 years. if there's a difference, it's going to be 6 years before you're going to be paying the full difference. You're only going to have to absorb a little bit of it every year. So it's really important, when you're working, your buyer's working on getting flood insurance, and anytime, you're going to get a mortgage, you're going to have flood insurance. That's a lender's requirement. And again, as I said before, I live in an X zone, but I get the insurance because a couple doors over, my neighbors have flooded out because they're in a lower area. And funniest thing I heard was the water doesn't know, does it, Rich?
Nope.
Water
It doesn't.
doesn't know. This is the one zone, this is an X zone. Oh, the water says, oh no, I gotta stop here. Anyhow, what about the private market? Is the private market a factor in flood insurance these days?
Very much so. It's becoming a big factor. So there's a few different private options. I know we work with currently 4 different private carriers. Generally speaking, the private carriers are going to be able to give broader coverage. You can usually get up to the policy limit of the homeowner's policy. So if it's a $750,000 home, we can generally put the private flood up to $750,000, as opposed to NFIP only being $250,000. Depending on the carrier, some carriers will also offer other structures coverage, loss of use coverage, ordinance or law coverage for private flood, which are not part of the NFIP. And again, some of the private carriers will do it at replacement cost, where NFIP, if it's a secondary home, it's going to be at depreciated value as opposed to replacement cost for any payout. So the private market is becoming more and more prevalent. There's certain areas that the private market blows away NFIP. There's other areas that the NFIP is still the best way to go. Every home is different. Every area is different. The biggest thing is the new construction homes. If they're buying a new construction home, the glide path rate's out because there's no existing home, so we can't get a discount there. We can possibly get a discount with an elevation certificate on the NFIP. But again, I haven't seen that help that much. It's helped in some cases, but generally the glide path is going to help 1,000 times, much more than the elevation certificate will. And then if it's like I said, new construction home, going the private option may be the best bet because you'll get a much reduced premium for the same coverage. And if it's in an AE zone or an AH zone and the mortgage is requiring it, they will accept the private flood at the 250 limit because that meets the every one of the private carriers has a letter on their website that states that it meets the FEMA and NFIP guidelines, that it's at least as good, if not stronger, coverage than the NFIP policy.
So years ago, when we were trying to figure out how to get private flood carriers to come in the market, they were kind of knocking on the door. Everybody thought, oh, the private flood carriers are just going to come in and take the easy stuff away. And then FEMA will be left with the hard stuff. And finally talking to some of these people, they're like, oh, wait a minute, we don't make any money per se on the easy stuff. We make the money on the harder stuff that we don't have to pay out against. So we want a mix of risk. And that's how these rates, I think, are getting better as a result of private flood. But the original thing was they're just going to cherry pick all the easy policies and leave the rest for FEMA. And that it hasn't worked out that way, has it, Rich?
Correct.
Okay. What's not changing? Residential and commercial policy coverage stays the same. The buyer can assume or transfer the seller's policy to avoid, as Rich said, to get into a glide path situation there. Still required to have flood insurance if you're in a special flood hazard area like AE or VE to get a federally backed mortgage. The community rating system, we don't spend a lot of time on that, but Collier County has been very aggressive as a community to get a CRS rating of 5. Many municipalities don't have that, but Collier County got very aggressive a few years ago, said, hey, we can save everybody a lot of money if we band together as a community and follow the steps to get a community rating. So we got to 5. Apparently to go to 6 is a huge amount of money and it's much more complicated. But to 5, I think everybody gets what, a 40% discount? Rich?
It's it's yes, significant discount. I'd say about 40% probably. Yeah, that's probably an accurate number.
Well, but I was working on a project, we worked with the county on it, we looked to get to 6 or 7. Tremendous, with the size of our county and everything, was tremendously expensive, but 5, there are not that many communities on 5. And many of them are much less than that. So, give a little pat on the back to the Collier leaders, because they worked hard on that. Elevation certificates, as Rich mentioned, can help you in some cases, but you do not need an elevation certificate to get a rate. You can call Rich. You can say, hey, what's the flood insurance rate going to be on this property? And what will it be if we assume, here's the deck page, what will it be if we assume that policy? So you can get that information right away. It doesn't take forever like it used to.
And an
So
elevation certificate will never hurt the premium. So if you have one,
you have
we
one.
can submit it. It's never going to hurt it. It might help it. It might keep it the same, but it will never increase the premium.
Okay, so the timetable is for renewal of and new policies, renewal and existing policies, April 1. We started back in October where we released the rates, and you could still stay in the old FEMA program. You got to transition now starting April 1st to the new program. So this chart's a little bit hard to read, but basically it kind of backs up what I was saying in that 86% of people will see either no increase or a $0 to $10 a month increase. So there are some out on the tail end that are going to see a little bit more, but very few, only 4% will see more than $20 a month in an increase. And actually sent us the data for Naples, Collier County, and you could see all the policies and you could see what the rates were. And sure enough, you looked at the rates for most of these homes. It was a big Excel spreadsheet thing, but we looked at it, and it really is true that the majority of the policies are staying where they are or only going up slightly. What's been your experience, Rich?
For the existing policies, yes, the maximum they can increase is 18% under the 2.0. I have yet to find a policy that 2.0 was a better rating, was a better premium than a 1.0 right now. So all of our policies have been renewing in 1.0 because we checked them all. So I in our office haven't seen any that have taken a decrease. But yes, most of them are small increases that would fit that. The major differences on the new policies, new construction homes, that's where we're seeing some major increases.
This was a slide that was put together for New Jersey, but it's the same basic thing. The idea was if you go to rate people on the basis of their true risk, okay, there shouldn't be a lot of change. And in the case of Florida, where we were a donor state paying in $4 every time for every dollar we got out in claims, on paper we should see a little increase or no major increase, and we will be on a glide path. They're saying that the average glide path is going to be around 9% till you get up to actuarial. So this is a few examples. Do you have any examples, Rich? Of
I
policy?
do. I emailed you over a few things. You can probably share it later.
Right.
I have about 4 different examples here. When we're talking glide path here, this home was built in 2014. It's in 34114 zip code. If we were taking out 250, 100, so maximum NFIP policy, we have an elevation certificate. It's an AE zone, base flood 7, lowest floor of elevation 7.6, so it's positively elevated by a little over half foot. The 2.0 rating was $6,654. Good news for the insured was that The seller of the home currently had an NFIP policy. I was able to apply for the glide path, and his premium that he bound was $996. So the glide path saved him $5,658.
There you go.
So that was pretty significant. Some other ones we're seeing here. New construction 34120, X zone had no elevation certificate. NFIP came in at 1762 for the maximum limits, which wasn't bad. I was able to find them a private flood option with Zurich flood at the dwelling limit of 350,000 for only $806. So in that case, X zone Zurich with a higher limit was lower than the NFIP, which again, Zurich private flood's nice because it adds extra coverages, and it also has a single deductible, where on the NFIP policies, you have a double deductible, one deductible for building damage, one deductible for contents damage. Another home I had here, let's see here. This one was Isles of Collier, 34113. New construction, but it's an X zone. NFIP came in at 6,776, and that was 2.0. Now that home in August before in 1.0 would have been $800 for that same flood policy. So that's where we're seeing a major difference. It's new construction, X zone. 1.0 it would have been 800, but 2.0 it's 6,776. Able to find a private flood option for them, 2782, and that's through Lloyd's of London, which is a very solid. It's a non-admitted policy, but Lloyd's of London's a very solid carrier with a lot of reassurance. So in that case, NFIP was almost $4,000 more than the private flood option. And then the last one I looked at. Again, still in Isles of Collier, X zone, had an elevation certificate. Lowest floor in this home was 8.1. NFIP 2.0 without the elevation certificate came in at 7832. With the elevation certificate, it came in at 6273. So the elevation certificate saved about $1,600. But again, this was a home that was built in 2019. So we were able to get a glide path rate because the homeowner had a policy, and we were able to get the glide path rate at 908. So it was a $6,000, almost a $7,000 savings for the glide path rate.
So are most of these quotes for 250,000 worth of coverage, even if they go to private flood, or when they go to private flood, do they usually go up a little bit?
So when we go private flood, we always take a look. There's some carriers that going from 250,000 to 750, 800, 900,000 is only an extra $1,000. So instead of paying 2,400, it might be 35, 3,600. But generally speaking, a lot of the people that I've been dealing with when it comes to flood, they stick at the 250 because that will meet the mortgage requirement. And they don't feel they're at a high prone flood risk. The people that are in the AE zones, they will generally go higher, but the X zone people generally stay at 250, even in the private market.
So
Unless we can find Zurich for them. The Zurich private flood is, in my opinion, the best private flood out there. Unfortunately, it's not offered everywhere, but where it's available, it's a very good policy. You get some great coverages, and it's easy to increase your coverage for not much more premium.
Okay, so for takeaways today, understand that it's really important that you reach out to Rich or your favorite agent and say, hey, what's this going to cost? And get your future homeowner to look at these costs and make sure they understand, because you're the source of the source, and who's going to take the blame when all of a sudden there's a $3,000 or $4,000 flood premium that we didn't talk about. you're being the center of the transaction, it's your fault, right? That's the way we take the good with the bad, but you know, if the messaging here today is whether it's homeowners or flood, make sure you get out front of this stuff and get the information, get your buyer to do their homework and understand exactly what they're buying. And also, if these are second homes for people, Rich, the rates are different, aren't they?
Yes, because they factor in the NFIP especially will factor in an additional $225 surcharge for any non-primary home. So whether it's a secondary home or a rental home, there's a $225 additional surcharge with the NFIP policy. So yes, that does increase.
But it's not huge.
Well, no, it's not huge in comparison to a $7,000 policy, but I mean, it factors. And that's something that I like to let people know is, you know, especially, you know, they're buying homes now with hopes of retiring here in a year, 2 years, 3 years. I let them know that when they make it their primary home, they're going to see their flood insurance decrease.
Okay. So a few of these slides left here. Obviously, hopefully we've been hitting the messaging home. Look out for your customer, make sure they understand what they're getting into. Prepare your clients that change is coming. Use the resources. There is a whole page of resources here, flyers and information pieces that I'd be glad to share with you so you could share them with your customers. If they don't have a policy now, the seller doesn't have a policy, the buyer needs to know what it might be, especially if they're doing any kind of financing. Okay. The other thing is to remember, stay in your lane, right? Refer them to qualified professionals such as Rich to get the actual information, because just because you understand the system doesn't mean you should be the source of any type of rate information or comparison.
Yeah, and listen, I'm here as a resource to you guys. If you have a question, just shoot me an email, a phone call, a text. I just need the property address and I can run it. I may ask you for your client's name, but generally speaking, when it comes in for realtor, I just dummy in the name client of Jeff Jones. And that way, because we have to put names on proposals, and then I can get you a flood proposal pretty quickly. I never assume that there's an existing flood policy unless my agency currently has the flood policy. So I will always send you the 2.0 rate. I will then send you, if I can find an elevation certificate, what it is with the EC. And then if you can track down the deck page, send me a copy of the deck page and I can go ahead and get you the glide path rate as well. And if it's a new build where we can't do glide path, I'll also try to look at some private options too for you. It takes me, the flood process now is about a half hour for me. I can generally get you proposals within a half hour for flood. Homeowner sometimes gets a little longer depending on underwriting.
Perfect. So anybody that is interested in this information, just email Jones Naples at KW. I'll be happy to share it with you. There's a lot of good links here. There's some videos. There's some more in-depth information. And that's the end of that presentation. Thanks for hanging in there with me through my Zoom trials and tribulations. Let me see if I can possibly put up the last page of this one. There we go. There's Rich's contact information. I didn't have his picture, but that's not important. If you need any information, my email's jonesnaples@kw. Call me, probably have my cell number, but definitely call Rich. He's a great resource. Thank you for your time today, Rich. You're always a pleasure to present with. You always have a lot of information, and we kind of tag team pretty well sometimes.
Absolutely. Well, thank you guys. Thank you for dedicating some of your day to learning about insurance and flood. And if you have any questions, shoot me an email, give me a call. I'm around pretty much all the time. And hopefully those that were in attendance in the room, hopefully the lunch came nice and hot and was enjoyable.
Sorry you couldn't join us today. So
thanks. Yeah,
everybody.
I know it's horrible, but thanks guys. Have a great day. We'll see you soon.
Thank you all. see anything in the chat.